In this first conversation, I dive into the world of blockchain, fintech, and tokens. I believe these topics are still relevant because behind these technologies, we have the potential of transforming the role of money and solving complex problems around collective action, which at the end are problems with trust across societal and economic actors. To do so, I have brought a wonderful lecturer from multiple academic centers, such as Berkeley, Stanford, and the HEC Paris. Gregory LaBlanc is a lifelong learner and instructor, and a person that, with his simplicity and rigor, help us visualize how we can create products, where to put our eye, and more importantly, what to be a skeptic about these technologies. I hope this chapter is of your interest, and see you around. Thank you so much, Gregory, for this conversation. Gregory is an teaching fellow at Berkeley. He teaches an intersection of fintech, smart contracts, business, and law. He also teaches several courses at Stanford. Among those, I was his student last quarter for a course on cryptocurrency and blockchain. And he also teaches at the HEC in Paris. Correct me if I'm wrong. If I missed any other things you do, you also offer consultancy, right? Consulting on fintech and stuff.
Yes, that's right, David. I also have a podcast called Unsiloed.
Anyway, thank you so much. I would like to start by asking you about the current moment of fintech and blockchain. And recently, I talked about this topic to a Stanford faculty. This person told me, like, why will you even use blockchain or any cryptocurrency if you have traditional banking? So I would like to ask you that. It was a hard question for me.
Well, that's actually a couple questions, right? So one is about fintech and one is about blockchain. And of course, most of the developments that are happening in fintech have absolutely nothing to do with these new kinds of databases. I mean, most of it is around the kind of re-architecting of the boundaries of different kind of financial functions and the use of new tools like machine learning to make decisions across the entire financial value chain. Okay, so that is where most of the action is. Now, of course, a lot of that has to do with using data, and so databases become relevant, right? And so the second part of the question has to do with blockchain, and I think this term blockchain has become kind of a shorthand for a wide range of innovations, some of which do not involve the use of what is technically defined as a blockchain, right? So, whether we're talking about new kinds of databases that track ownership, new kinds of contractual forms that are built on top, or contractual execution forms that are built on top of these databases. So, I don't really like to use the term blockchain because it's too narrow, but people more generally talk about things like distributed ledgers, right? Which is kind of, I think, in many ways a more accurate description of the kinds of technologies that we're thinking about.
I see. So with the idea of distributed ledgers, and we talk this in class, basically what we're solving is a collective action problem, a trust problem. Do you see, like, based on what you have been exploring in the last years, that blockchain or a shared ledger is offering any concrete solution to this trust problem, or is it still very far away from its goal?
Well, it's funny. I just did a podcast interview this morning with an Italian banker who had done a bunch of research into the history of banking, and he went all the way back to Pisa in the 1300s. And what they had were these public ledgers. And so pretty much any kind of promise or obligation between merchants was listed in some central database. So you could walk on down to, the City Hall of Pisa, and you could inspect the books, and more or less every obligation was there for public display, right? Now, of course, the way in which it operated was that there was this bank that was sort of sitting at the middle. It was like a single bank. There was a single entity which kind of did all the clearing and settlement of all these interlocking obligations. And so the notion of a database that kind of has all of the different ownerships of all the different claims, this is an old concept, right? And
Right.
nowadays what we have is we have all of these different individual entities, and they have visibility into their own assets and their own liabilities,
Mm-hmm.
and that's it. And then if you go further up the chain, right, then you have sort of central banks, but the central banks, they themselves only have visibility into the claims that they have, right, with their member banks and so forth. So just thinking about the kinds of data and the visibility of the data
Mm-hmm.
is one question, right? Then you think about, well, where is that data located? So is it located in one central database where there's an individual entity or
Mm-hmm.
agent who's responsible for supervising the whole thing, like
Right.
in PISA, or is it in some distributed form, right, where it is kind of sitting in all of these different nodes? So that's kind of like the database question, and each of them comes with different problems and different trust problems, because if you have it all sitting in a central place, then you have to kind of trust that that central repository maintainer is
Right.
doing their job right. And so back in Pisa and Venice, they would have a government regulator who would come in and inspect the books. But then, of course, you had to trust the government regulator. When it's in a more distributed format, then then that's when it becomes a little more complicated, and you need these more these kind of cooler technologies that have come about in the last 20 years.
Right. Right. And I think you touch a very sensitive issue right now between trusting the government and the cryptocurrency blockchain innovators. Right now, it feels that the industry is in a gridlock, at least from my point of view that might be limited. Um, why an innovator here at Stanford and anywhere will invest, or what do you think it would be logic rational to invest or develop solutions in this field if the government is pushing for uh regulation, and on top of that we have seen all these scams and sort of Ponzi schemes? Do you think it is rational at all to invest in this industry?
Well, okay, there's a lot of things going on here. So the thing that most people think about when they think of blockchain is they think of cryptocurrencies. And when they think of cryptocurrencies, they're thinking about these private cryptocurrencies, private
Hmm.
money, right? Like Bitcoin. And that kind of private money that is untethered in some way from the mainstream financial system, right? The TradFi system. I think that has very limited applicability. I think it has very limited value. You can see why, of course, people have an interest in having a private money or a private currency. And there have been private monies and private currencies throughout history. So famously, in the Middle Ages, there was something called the écu de mar, which was sort of a private currency that all the bankers used across Europe, right? And they recognized it with each other, and it was, independent of all the national currencies. So, there will be a demand for a private currency when the public government-sponsored fiat currencies fail to do their job. And so in places like Venezuela and Argentina, where the currency has sort of fallen apart, there's going to be a demand for an alternative. And that could be a US dollar, right? Of course, that
Hmm.
pretty much does the job. There's very little reason why you would want to use something other than US dollar in those countries. But, crypto has enabled you to use, if you're trying to make payments with the US dollar, it's very difficult, right? You have to
Right.
carry around baskets of cash, or you have to do transfers up in the American system, which is very unwieldy. So, it's a powerful tool. In the more kind of functioning systems like Europe and the US, the only real reason why you would want to have a private currency is because you're trying to break the law. You're trying to evade taxes, or you're trying to engage in illegal commerce. Maybe you're doing some kind of blackmail or
Hmm.
ransomware kind of stuff, right?
Right.
And it's a lot easier to use crypto than it is to move around stolen Picassos or suitcases full of cash. All right. So that I think is, but then of course there are these, private stable coins,
Mm-hmm.
which can actually, they're quite useful, and they're useful not just as a way of buying these other cryptocurrencies,
Mm-hmm.
but they can be the foundation of some other cool activities, right? So there's that. But I think that the main reason why it's important for people who study finance to look into these tools is because the most important applications are within the mainstream financial system.
Right.
Because the technologies that we have for clearing and settling are actually quite archaic. I mean, they're built on trust. They're built on, I mean, they have this kind of structure that is highly centralized, but it's a bit clunky. And so everybody's been trying to figure out new ways of moving value around. And that's why I think I think it's important for finance students to be aware of this. It's not simply about, hey, let's go into ransomware and stuff, and let's just figure out new ways to facilitate gambling and speculation on all these useless coins.
I was impressed by one conversation we had during class, which was when you brought this Blackstone. Oh, no, sorry, BlackRock. I'm now confusing two giants. And we were talking about ETF Bitcoins. And that was surprising because it seems that traditional banking is aiming for, something that is non-traditional, non-orthodox. What do you think about that move? Like, why traditional banking is interested in launching a Bitcoin pegged to an ETF?
Yeah. So, in that class, we have a lot of people come in, and they're coming in from the traditional financial world. Okay. In prior years, the only people I could get to come and speak in these classes were people who were doing things that were a bit outside of the mainstream finance.
Mm-hmm.
Now, it's mostly people in mainstream. But the example that you're citing, which is the BlackRock ETFs, that's still in a way piggybacking on this alternative currency, right? Bitcoin. And so, they're still relying on Bitcoin as a viable thing for this to have any value to them. Now, why are they doing it? Well, they're doing it because, as you know, trading in Bitcoin is quite clunky. It's quite difficult. It's quite clumsy, which is why the vast majority of people who are buying and selling and storing Bitcoin do so through the use of a wallet, right? Something like a Coinbase or Binance, which means that they're not actually owning this thing at all, right?
Yeah,
But
that makes sense.
But even then, like if all you're doing is trying to get some exposure, well, then you don't really need to own the thing at all. I mean, if you're interested in getting exposure to the S&P 500, you're not going to run out and buy 500 stocks. You're probably going to typically just go and buy an ETF, because the ETFs are just incredibly easy to buy and sell. If you look at, if you buy crypto on Coinbase, every time you buy it and sell it, you pay a fee. And that fee is pretty substantial and can start to accumulate over multiple transactions. And so the liquidity associated with an ETF is just orders of magnitude better than what you would get if you get exposure through some other tool. Now, of course, Coinbase is trying to provide institutional accounts and so forth. They're also heading in this direction. Now, the real question is, well, why would anybody who is a normal investor want to have exposure to this? Well, think back to modern portfolio theory. Modern portfolio theory says that if you want to have the best return for your given amount of risk, or the best risk for a given amount of return, then you want to have the most diversified portfolio possible. Which means you want to have not just domestic stocks, but like every stock on the planet. Not just stocks. You want to have fixed income, but not just fixed income. You want to have real estate, but not just real estate. You want to have commodities, right? So like any investable asset out there, you want to have a little piece of it that is proportional to the market cap of those assets. And so if this thing is an asset, Now, of course, you could go crazy with this, and you could say, "Well, what about commercial paper? What about IOUs? What about baseball trading cards? What about wine? Right? I mean, hey, I've got a substantial amount of my wealth tied up in wine, right? And I haven't actually done the mean variance, right?
Right.
Computation. I haven't plugged it into my optimizer. But if you really believe in modern portfolio theory, then even if an asset has zero fundamental value, like even if you believe fundamentally that it's got no fundamental value,
Hmm.
doesn't matter as long as this thing's trading. You got to have a piece of it. I mean, GameStop is totally worthless.
Yeah.
It's a crazy
Good
thing, but
example.
you got to have it in your portfolio, right? So there are a lot of people, institutional investors, sophisticated investors, there's pension funds even, who are saying, hey, maybe we need some exposure to this. Okay. And they call it an asset class. I mean, that's a
Hmm.
philosophical debate whether crypto is an asset class, but you know, I mean, you can get exposure indirectly through buying Coinbase shares and so forth,
Right.
but that's part of your S&P 500. That's not including the underlying, commodity. So BlackRock identified a need. They realized that there are a lot of people out there that want exposure. So, passive exposure, and there's one way to get it. But it's also useful if you want to speculate. If you want to speculate, this is
Right.
it's a really easy way to do it.
It sounds that you see most of the applicability of this technology by pegging into things or instruments that are already into traditional banking. For example, stable coins pegging into real coins, or in the case of the Bitcoin ETFs, already taking a popular financial instrument and then make it available for
Yeah.
traditional uh, Bitcoin investors. That sounds super interesting. And my final question is related to this book that you're probably familiar with, Tokens by Rachel O'Dwyer. She talks about tokenizing real assets,
Mhm.
and with that tokenization, you're basically are enabling what we're just mentioning, trading whatever, trading from a piece of art to anything. Uh, do you think tokenization is something revolutionary, something that indeed allows us to have more arbitrage and better yields in the market?
Well, of course, you skipped over by going from cryptocurrencies to
Yeah.
real assets. You skipped
Yes.
over actually.
I had to ask you a real question here.
You skipped over about 99% of the financial system, right? I mean, you know, and so when we think about things like futures, okay,
Hmm.
or we think about current FX, or if we think about stocks and bonds. I mean, these are financial assets that currently use a system of clearing and settlement that
Right.
could use little innovation. And so we had another speaker in our class, as you may recall, that talked about the use of smart contracts for
Right.
FX.
Yep.
And this, I think, is actually quite fascinating and interesting and intriguing. And I'm following it very closely to find out whether or not this could be a revolutionary application. Because as you know, right, when you are doing something like a foreign exchange transaction, I'm sending you whatever, $50
Hmm.
million worth of euro, and you're selling me, $50 million worth of dollars. That's a transaction which happens every single day in hundreds of billions of dollars every single day. And we don't really pay much attention to how that stuff works. But the way it works really is that you have these people sitting in the middle that we
Right.
all trust, and that we expect that they're going to give us the money back and not walk off with the money that we gave them. But
Yep.
if one leg of that trade, if there's a hitch, then one side could potentially receive the money and the other one doesn't. Okay. And so, what we want is we want to have this stuff take place simultaneously, right? It's just like, if I'm on eBay, think back to the original problem with eBay. You send money to get some item and the item doesn't show up, or someone sends the item and the money doesn't come. So, there, I think there's a lot of interest in facilitating smoother and more reliable transactions. Now, fast forward to the problem with real assets, with whether it's property or large scale financial projects.
Mhm.
I do like the idea of slicing and dicing. And, we've been slicing and dicing for years, for decades, right? Through special purpose vehicles that allow you to buy, claims on claims on claims and
Mhm.
fractions of claims, so forth. So, it's not unheard of to do this. And so I'm super excited about the possibility of creating new types of financial instruments that are tied to other sorts of assets. But we have to remember, and this is something that engineers typically get wrong, is that the obstacle to liquidity is generally not having to do with the tradability of the asset. In other words,
Mhm.
the technical tradability. Right. So like when Warren Buffett decided to create these second class of shares,
Mhm.
you didn't have to spend $200,000 to get a share. This didn't fundamentally do anything really. It created more democratic access, but it didn't lead to better price discovery or anything like that. Okay. Because when it comes to price discovery and liquidity, the biggest obstacle is the dissemination of information, right?
Oh,
And whether or not
right.
you have enough people who are cognizant and studying the asset so that you have people on both sides that have confidence that the value makes sense. Okay. Now, granted, if you kind of create a technology that makes it easier to trade, then you can inject more information. People have greater incentive to study. You'll get a wider pool of people interested. But for a lot of these assets, that's not really the problem. That's like if you look at, Stripe. Why is Stripe private? It's not private because the stock market doesn't exist. you know,
Right, right, right. Yeah.
and so they could push a button and boom, have stock, tomorrow. It's rather a lot to do with the what we call liquidity, but liquidity is really about information. So I get excited. I really am excited about new types of assets, but we can't think that this is sort of a magic bullet that's going to unlock tradability in areas where we don't have tradability.
I'm going to take with me that sentence you just said, which is it's not a problem of tradability, it's a problem of information. I think engineers we often commit that mistake because we're thinking on okay, the technology that enables trade. I would like to close this conversation by giving you thanks for your time, and hopefully we can talk more about tokens. Given that, for me, that's fascinating, and particularly applications on public contracts and all the stuff that is out there. But anyway, thank you so much, and have a good one.
Thank you, David.